Welcome to CFTC Talks. I'm your host, Andy Bush. Hey, remember, there's an important disclaimer at the end of the show you should listen to. Wow, it has been a wild start to February with yields on the U.S. 10-year rising from 2.1% essentially at the beginning of the month, 2.10 at the beginning of the month on 2.1 to about 2.88 before falling when the Dow Jones Industrial Average had its largest decline in its history on one day. The VIX, or the Stock Fear Index, has risen from a low of 13 at the beginning of the month to over 50. So clearly, the markets have become unsettled from the extraordinary calm that they experienced in 2017 when there was no move down in the S&P 500 over 2% for the entire year. That is extraordinary. Here to provide some context and clarity on the markets is Northwestern Mutual's Chief Investment Strategist, Brent Schutte. Brent, thanks for joining us today.
Thanks for having me, Andy.
Hey, before we get to the markets, just for our audience, could you please explain your role at Northwestern Mutual?
Sure. So I am the Chief Investment Strategist of the Wealth Management Company, which is a subsidiary of the insurance company. And I manage the retail wealth management process, philosophy, and implementation from mass affluent all the way up to high net worth. And that's my primary role at the Northwestern Mutual.
Well, let's get to the markets then. That is a lot on your plate. So this is going to be great. I'm really looking forward to hearing your comments. But in the news and media, obviously, there's a ton of headlines stating that this is the worst one-day sell-off in the history of Dow Jones. And many investors, you probably know, begin to worry. Is this an accurate portrayal of what's happening, or is there something else going on here?
Yeah, I think the most important thing that I can say to an investor is that I do believe this is a correction, not the start of a recession. And to me, recessions, if you look historically, are what cause prolonged market downturns.
Mm-hmm.
Corrections occur when people are positioned wrongly, and then they have to reposition quickly, and that causes a sharp, but often shorter market correction. And so I think what happened over the past couple of weeks, if I can take you back to last week, is that we had an environment where there were a lot of people positioned for lots more central bank easing. There was still the low inflation and low interest rate trade and low volatility. And then we had strong economic data come in with leading economic indicators of that inflation showing that they were possibly rising. And that changed the tone to one where people had to reposition for now possibly more central bank tightening, maybe more aggressive, for rising inflation, rising interest rates, and more volatility. And so to me, this started out last week as an interest rate thing. Yesterday, it certainly still was an interest rate thing. And then somewhere around 1 o'clock, I believe, or 2 o'clock, I don't remember the exact time, it led into the VIX market, which is where people were positioned with this trade that volatility was going to remain low. And they ended up having to puke out of that position, which caused kind of some knock-on effects because volatility, as you mentioned, spiked. And that's where we ended up where we were yesterday afternoon. And so, I think those things eventually passed. The economy is still strong. And if I can tell you one thing, if I look from point to point, if the economy is up a year or two from now, there is a high probability that the stock market will be up. I just think it's going to be less because of where we are from a valuation standpoint and that we are nearer to the end of the economic cycle. And I think investors are going to have to stomach more volatility moving forward.
Hey, listeners, I just want to point out when he's referencing Monday, he's talking about February 5th. So just to be clear, whenever you're listening to this, sometimes people get to listen to it a little bit later.
Sure.
But I think that's a great point. So then I guess it begs the question, how do you view this newly discovered volatility? Is this the shape of things to come?
Yeah, you mentioned not having a 2% drawdown last year. Last year was abnormal. In many cases, we had the lowest stock market volatility going back to 1965, and you had the lowest spread on the 10-year high and the 10-year low for the year since also 1965. And I think the thing that these time periods have in common, 65 and today, is that you've had a period of time where central banks are intentionally and have been intentionally trying to push down the price of risk. Let's be honest, that's what a central bank tries to do when they flood the world with liquidity. We all feel a little bit more confident.
Right.
I think you're now at a place where we've kind of turned the corner to where nearly every central bank around the globe is now, in some form, taking away at least some of the easing, in some cases outright tightening. And if you look historically, that typically is the prescription for higher volatility. And so I do think we need to get used to it. Now, I don't think we're going to have 5% moves in a day all that often, but I do think volatility is back and is probably back to stay.
Yeah, I think it's a great point about the uniqueness of this time frame where we had synchronized global growth, and I had Joe Livornia on the show recently, and he pointed out the last time that occurred was 2007, but it occurred for 4 years. Now we're having synchronized, to some extent, central bank action, not on the easing side, but on the reverse of that, as they try to come back to normalize monetary policy. And your point about this could drive volatility is really interesting. So let's get back to a little bit maybe of what's driving the recent action. Obviously we had this massive drop after the employment data, and just hang with me. The market narrative appeared to focus on the rise in average hourly earnings and the risk for the Fed to have to raise rates at a faster pace than what was currently being anticipated. Is that an accurate assessment?
Absolutely. And people are fixated on the jobs report and the average hourly earnings there.
Right.
But there are other leading indicators of inflation that are pushing higher. And last week we had an incredibly strong ISM manufacturing that showed prices rising, and there's anecdotes and comments, and even the market ones that are put up by a different provider of some price pressures that are in the system. And it's not just here, but it's in the Eurozone too. And then you also look at the ISM non-manufacturing on yesterday or Monday, the 5th, as you mentioned, and it also had rising prices in there. And so if you look around right now, this reminds me of the conversation we had last year where guys like me were sitting around and saying economic growth is coming, and people were saying it's not showing up in the hard data yet. And so we had this soft data versus this hard data argument.
Sure.
And my fear coming into this year was that we were having the same argument, I think, on the inflation side, where people are suggesting that it's not showing up in the hard data yet. And I was suggesting that, current levels of hard data inflation tell you a lot about what happened 18 months ago or 12 to 18 months ago. And so as we kind of wear off those time periods, we've had 3 strong quarters and we're looking at a 4th strong quarter in a row, that should lead to rising inflation pressures in the future. And I think the market is starting to get that narrative. And that was kind of the slap in the face that I think traders needed to kind of move out of some of these positions that they had been in for so many years, because we've been in a low inflation environment. And so I think that the environment is changing.
Yeah, so that combination, and I think this is really fascinating, ladies and gentlemen, because you talk about soft inflation data and then hard inflation data. And I was reading your notes and I was just going, that lag is so long, between 12 to 18 months. It just surprised me that people still focus so much on that. So I guess it's a question of getting back to the Fed. Do you think they'll reach their 2% inflation target for personal consumption expenditures in 2018?
So I think the answer is yes. And I guess I've kind of positioned this whole recovery as if the textbooks still work. And so it seems like this
that's helpful.
We all wonder if we wasted our money going to school and whatever else it may be, and that we need to rewrite new textbooks.
Right.
But I think everything that will happen in the past cycles will happen in this cycle. It's just taking longer to get there because the scars of the Great Recession were so deep on consumers that they behaved differently and more moderately. They were so deep on business owners, they behaved differently. And importantly, from a fiscal standpoint and from a monetary standpoint, everything was done in this country to make the world safer and to rebuild our system. And so think regulation, think Dodd-Frank, think the government actually not spending as much money and kind of trying to pull down the deficit. Now I think you've reached a point, and this was part of my call last year for stronger growth, where the consumer now feels that they've rebuilt their balance sheet and they feel comfortable. You're starting to see, and for that matter, they're getting wage increases now. You're starting to see business owners become incredibly comfortable, and now they're actually spending on plant, property, and equipment for a variety of reasons, not just the tax reform, but I think that was, obviously will help there. And from a fiscal standpoint, everything is now being done to speed it up. And so, I guess I continue to think that the Fed will reach their 2% target. I think this cycle will end like all others with 3 things happening. 1, we run out of slack. 2, that causes prices to rise or inflation to rise. And 3, the Fed eventually raises rates enough to stomp it out, because the Fed believes, at least in modern terms, that if you moderate the boom, the bust won't be so big. And so kind of where we're at right now, we're kind of running out of slack, but we're still finding some workers, and maybe we're not quite there yet. I think inflation returns in 2018. Perhaps early 2019. But I think the thing that still gives me some confidence that we have time left in the cycle is that I don't think this Fed is going to moderate any boom. In many cases, Janet Yellen told you she was going to let it run hot. And I think Jerome Powell is Janet Yellen part 2. And so, we might get faster rate hikes than what the market imagines, but I think the Fed is still going to go incredibly gradually because they have to, bring us back from how far they've swam us out in the waters. And as we saw tomorrow or yesterday, the last few days, if that happens anything other than gradually, it can cause some problems.
Right. Well, let me ask you about a little bit. Let's shift gears a little bit here about some of the structure in the equity markets. Obviously, the dramatic drops on Monday and Tuesday. There's been a lot of discussion on how algorithmic trading is driving prices farther and faster. What's your view here? It seems like this is the great boogeyman that's out there, and I guess it ties back into the concept of increased volatility and if that's here to stay.
Yeah, I don't know if I have hard data numbers on how much algorithmic trading exists or doesn't exist, but I do feel today that certainly it feels to me like the market is more reactive in that it waits to see the whites of the eyes before it actually does anything. And so I don't know how much money is still traded on fundamentals versus machines, but I think the machines are probably rising and a lot of those things are rule-based. I've heard a lot about this outcome investing where we create these indices and then, I'm not saying it's buyer beware, but, the creator of the inverse VIX would say, well, look at it, it did exactly what it's supposed to do. And people chose to buy that.
Right.
And so I don't know if that leads to more volatility in the future because we all have access now. At least there's more access because of the innovations that we've had to things that perhaps maybe some of the consumer doesn't understand what they're actually doing. And so I don't know. It just feels like to me like we're less about fundamentals anymore and we're more about computers and trying to trade faster than everybody else. I think for years we actually had people set up trading hubs so they could get the data faster and react to it faster. Mm-hmm. And so kind of given the time horizon that I have here at Northwestern Mutual and the fact that I'm not going to out trade any trader, we still do try to take a more fundamental based approach. I pay attention to the economy a lot. And I still think there's an opportunity to arbitrage time horizons when people may overreact. Hopefully that we can take advantage of that.
That's interesting. So you're in your approach to investing for your clients, walk me through like what are the top 3 kind of fundamentals or planks in that thought process and how you go about it?
Sure. So every single one of our strategies begins with a long-term outlook. And so someone won a Nobel Prize for this, so I'm not recreating the wheel.
But you'll take credit for it. No, I'm just kidding. Yeah, I'll take credit for it. How about
I think I want the money that goes with the Nobel Prize.
Yeah.
That's up to $1 million now.
Yeah, that's nice.
No, but, so we do still believe in diversification. We believe it works.
Yeah.
And over longer periods of time, that efficient frontier that we all talk about, that does tend to play out. So normality, I think, does tend to win out longer term. For example, stocks typically outperform bonds on a longer period of time. Emerging markets typically have a higher return than U.S. equities because people are rational longer term. So, for example, if you are going to buy emerging markets and they're riskier, you might demand more return for that. And so we add it all up that way and we come out with a strategic asset allocation. But as we've all witnessed, normality does not exist in the shorter term. And so we can have periods of time where fixed income outperforms, for example, equities. We can have periods of time like we have for the past 4 or 5 years where emerging markets underperformed. And so we make small tweaks to our overall asset allocation to try to help improve the risk return that we get from those. And so I've kind of positioned it this way. I was a Chicago guy. I lived in Chicago and I took the job up here at Northwestern Mutual in Milwaukee. And the first day to work, before I got in the car, I went online on Google Maps and I put in from my house in Chicago to Milwaukee, and it provided me the normal path that I would take over the next, say, 10 to 20 years if I were to drive that route. But as we know, and that's to me like strategic asset allocation, that is under normal times, that's the route you're going to take. But we all know that, when we have driven, I think one of the first few days I drove to work, I had my Waze out or Google Maps. And as I was driving, there was an accident. And so I got routed off the road. And so times weren't normal. And so that to me is kind of what the dynamic tweaks that we make to our portfolios are that help route us around that accident and hopefully get us to our end destination just a touch quicker. But I guess from the standpoint of what we do longer term, it's all still about, having a client go through a financial plan, matching that plan to a portfolio, and then sticking with it and staying invested. We just try to make little tweaks to it along the way. to help add value above and beyond that.
I love that example. Having driven between Chicago and Milwaukee many times, I can tell you that, yes, you have to overcome a lot of obstacles to get where you want to go between those two cities. So
you got to be careful. You got to be careful. You have those Illinois plates when you come into Wisconsin.
That's right. I just go there for the cheese. That's it.
There you go.
No, it's great. I love Milwaukee. Great summer festival there for sure. But that aside, at the end of 2017, I got to ask you about this because this is great. You wrote in your fourth quarter research that your biggest worry for 2018 was the return of inflation and its impact on the financial markets. And this is really, it appears that it's happened, right? So why did you write that then? And what's your view now? I mean, where do you see things going?
Yeah, so I wrote that because I just feel like the market it was priced for inflation to be a relic of the past. And so I know there's a lot of belief out there that inflation will be lower in the future, and potentially it may be. And people make the argument that really longer term demographics, dictate that that's going to be the case. But I don't think that means that we can't have spikes in inflation. And I think that the economic textbook work. And to me, the bond market was priced without regard for that, largely because of a lot of the actions of central banks and the fact that inflation has been low. And so I was just worried that you would have some sort of a hiccup that would start in the bond market and feed through the equity market, because those two are connected.
Yeah.
To me, stocks are rationally expensive right now. It's hard to argue that stocks are cheap. I hear the arguments, but from most standpoint, it's hard to find valuation metrics that show them as being cheap. And that is because right now the competing asset class, bond yields, are incredibly low. And so my fear was that you'd have a little bit of a shock in the bond market, potentially a hiccup, and that would feed through to the equity markets. And that's kind of what we've had. I guess the one thing that I added on the other side of that, at the end of that commentary, was that if you look back historically and you go back to 1984 and you just look at the market on a year-over-year basis measured quarterly, which is when people get their statements, there are only 4 clusters of negative returns. And 3 of those 4 occurred around recessions. Mm-hmm. The 4th was 1987, which to me was how people were positioned, kind of like we had recently.
Right.
And so the one thing that I'll tell you is that I believe that from point to point, like I mentioned earlier, that there is still space in the economy for it to move higher for the 3 reasons I mentioned earlier. And so I think from point to point, the market will be up. I just fear that we had to have a correction in between because the fact that the market was kind of mispriced and misallocated for what I saw potentially coming, which was inflation.
Yeah, that's great points. All right, before I let you go, I got to look forward a little bit, and because you speak with so many investors, I got to ask you, like, what are the things? What are the top 3 things you're telling people right now?
Yeah, so I guess one thing you asked me a question before about the things that I look at. So the things we use to make those tweaks are we do look at the economy, we look at valuation. So valuation is a magnitude moderator. To me, markets don't die because of valuation; they die because of recessions.
Yeah.
Then we look at fiscal and monetary policy, and last we look at something called sentiment. And so I will tell you that one of the things that I do is manage sentiment. A couple of years ago, obviously, I had trouble. I'd go out on the road and I had a fairly optimistic equity market message, and that was met with a lot of disbelief, and that has kind of morphed into some more optimism. And so I just want to make sure that investors, aren't over their skis too much, that they aren't doing some of the things that we talked about before with that inverse VIX that they may not have known about, and that they're still, keeping that longer term focus. In general, people are more optimistic now than what they were, a few months ago. But I will tell you, there is still a fair degree of skepticism out there. So the one thing that I always tell people is, obviously, investing success is not based upon panicking or selling things like yesterday. It's based upon having a plan, staying with it. Sure, we can make minor tweaks to it, but your strategic long-term asset allocation is going to drive what most of your return that is, and that is dictated by a financial plan that ties all those things together. And so, I think just managing the sentiment is one of the biggest things that's out there. The other thing I'll tell you is that, over the past couple of years, the market has become incredibly political. And the one thing I was saying before last year's election, and I still get a lot of political comments wherever I go, is that, I've done this for 23 years now. And I recall back in 1996, I'd have clients calling me from one side of the aisle and saying, "Can you believe that guy won?" In 2000, it was, "Can you believe that guy won?" 2004, it was, can you believe that guy won again? And then in 2008, it was like, oh my gosh, can you believe this guy won?
Yeah.
And on and on and on. And the point is that the market is higher from each one of those points. So to me, presidents are a plus or a minus, not an absolute positive or negative to equity gains. And a lot of what's happened is already, presidents may get a market that's already cheap, but they may get a market that's expensive. And so I just want people to keep their politics and check them at the door, because to me, that can maybe affect certain sectors. We just talked about deregulation after regulation. But, I just find that some of the worst investing is done by people who invest solely based upon what they think the policy should be, not based upon what the policy is. I've always joked that if I wanted to make policy, I'd go to Washington. My job right now is to kind of read what the policy is, and then have an opinion about how that may play out in different financial markets, and perhaps tilt our portfolio in that direction.
All right, Brent Schutte, Chief Investment Strategist at Northwestern Mutual. Thanks for coming on the show today.
Thanks for having me, Andy.
That's our show for this week. If you want to listen to more podcasts, you can go to our website at cftc.gov and click on the podcast button. Or you can go to the podcast button on your phone and type in CFTC Talks and click subscribe to get them every week. We cover everything we watch at the agency, from interviews with weather experts to the chairs of the powerful House and Senate ad committees to economists like Joe Livornia. Check them out. We'll be back next week with another guest on our quest to learn about the markets we watch. I'm Andy Bush. Thanks for listening. This is CFTC Talks. But wait, we're not done yet. It's time for a disclaimer. The CFTC is providing this information as a public service, and it is neither a legal interpretation nor a statement of CFTC policy. Reference to any specific product, service, trademark, manufacturer, or service provider does not constitute an endorsement or recommendation by the CFTC. The CFTC is not liable to any consumer or any third party for any direct, indirect, incidental, consequential, special, or exemplary damages or lost profit related to the use of the information provided or referenced in this podcast. Selection of guests on the podcast does not imply an endorsement of any particular individual or entity. Many individuals and entities provide similar services to those of the guests. The views and opinions expressed by the guests in the podcast are their own and not specifically endorsed by the CFTC. Moreover, the information provided in this podcast should not be construed as investment advice. Consumers should rely on their own inquiries as to accuracy and relevance of the information incorporated or referenced in this podcast and assume the entire risk related to its use. The CFTC is providing its interpretation of market trends solely to inform the public of a framework for projecting possible outcomes under different scenarios. If you have any questions concerning the meaning or application of a particular law or rule administered by the CFTC, please consult an attorney.